Jonathan, what are you looking out for in terms of cost cuts, but in terms of also of how they grow revenue?
Well, I don't think it's a surprise that you're looking at double-digit expense cuts, because revenue is going to fall by at least that. And if you look at the read across from the US, we've seen equities trading down 20–21% on average. That's going to be worse in Europe. Worst case, sort of mid-30s probably. UBS has warned that trading will be down a third. And fixed income was down about 10% with the US. Again, it's going to be worse in Europe. And I think the things to look out for, one, yeah, Barclays does have to outperform. I mean, they have to put in a much better number, or much less bad number than the European peers. And the French. I mean, they've been pretty appalling now for 3 or 4 quarters. Equity derivatives was a strength. Look at SocGen, look at BNP. They've announced some cuts. We need more.
Jonathan, how are activist shareholders, and especially the one at Barclays, basically putting pressure on them to change the bank?
Well, they're not saying anything that everybody didn't already know. And the fact is, difficult revenues, the one lever you've got to pull is costs. Barclays hired a lot last year, they invested a lot. That's the reason that their franchise outperformed Europe and is nearly keeping pace with the US. So if they keep pace with the US and have a sort of mid-teens or better fall, I think he's in a pretty strong position, but he will have to address costs either way. And they've given us the range of 13.6 to 13.9 billion this year. He needs to be at the bottom end of that and probably tell us if trading gets worse, we'll be below the bottom end of that.
John, I want to bring up the chart, which I think really, and you've been great on this over the number of quarters, giving us the scope and scale of EU and American banking. JP Morgan up here with 255,000 employees. Deutsche Bank, we all know the disaster that is with 91,000 employees. And Jonathan, what is so apparent to me coming off of 2017 is Barclays is in a no man's land. Jess Staley goes to the board and says, strategically, this is who we are. Who is Barclays?
Well, the funny thing is, I mean, you can compare it to US investment banks, but also don't forget RBS and Lloyds. They retrenched. They're 95% UK banks. They've hugely outperformed this year. Barclays, Brexit fears have waned. So you kind of, it's not winning on one side or the other. To my mind, who are Barclays? Well, they're a wholesale-funded bank. They've got a big investment bank, which means they've got a bloated cost base. They're going to continue to trade at a discount to the pure play retail. The only issue you've got is how big does the discount need to be? And at the moment, it's kind of up towards the cheapest, arguably, end of the sector, which is a SocGen, a BNP, but for a reason. If they can deliver this quarter, that's 4 quarters in a row where they've proved the investment bank actually is doing better than the rest of Europe and keeping up. So where do they belong? Well, they're still a wholesale-funded bank with a big investment bank, but the gap versus UK peers now, if they actually start delivering on their buyback talk, I think they would narrow the valuation discount. But that said, I don't think they're going to do anything on buybacks yet, even though he goes on and on and on about it.
Okay, when in doubt, do a McKinsey, do a merger, be strategic, use the word synergy, which John Tyce never uses. Where's the merger that salvages Jess Staley's career?
I don't think Barclays needs to do a merger. I mean, they've pulled out of so many parts of Europe. I mean, they bought in Spain many, many years ago when I was back on the buy side. And I remember at the time thinking, oh, great, so expansion. You look at most banks now, the only reason you want a merger is to cut the outdated retail banking franchise where you've got branches that aren't used and tens of thousands of arguably cheaper than investment bank staff that, again, aren't needed. So for Barclays, you don't need to do that. They can bring people in when they need to. So no deal for them. Deutsche and Commerzbank, slightly different. They really are struggling. Their return on equity is less than half that of Barclays, which is already pretty low. That's where you need deals. And well, Deutsche needs to shrink. Commerzbank needs to have an overlap with an UniCredit, say, in Germany, cut costs there, and just stick to its knitting.